Stocks rallying after President Trump clarifies he has, quote, no intention of firing Fed Chair Jerome Powell. However, Trump did reiterate he would like to see Powell be more active in lowering interest rates. For more on what this means for the Fed and the economy, let's get to Shelly Antoniewicz, investment company and institute chief economist, as well as Eric Rosengren, visiting scholar at MIT Golub Center and former president and CEO of the Federal Reserve Bank of Boston. Thank you both for being here. Eric, I want to start with you here, because even if President Trump has removed this threat, can the Fed go forward and make non-political decisions or decisions that are not seen as political, given this very public discussion?
Well, I think the first question is the threat removed? So what he has said is he has no intention of firing Jay Powell, but while Jay is the current chair, we really care about independence of the central bank over time, and that requires both the executive branch and the Supreme Court to believe that there are advantages to having an independent central bank. And so just by having the discussion that we've had over the last week and some of the market reactions that we've seen, there's already an issue about whether people are viewing the United States as a safe haven, and that can be seen when you see days where the stock market went down quite significantly, but the 10-year rate went up. And that's not what you normally see if you're a safe haven. So I think just having this kind of discussion is actually a bit dangerous for financial markets. Jay is going to have his term come up in the spring of next year, May of 2026. The president gets an opportunity to appoint a successor. So to some extent, it's a little surprising that he picked this fight with somebody who has only roughly 1 year left in office. But the bigger issue is, does he really believe that there is a role for an independent central bank? And I think that remains to be seen.
Eric, as a follow-up to that, are there any concerns that you've seen in regards to actually the credibility of the Federal Reserve and kind of Chair Powell's comments sort of guiding the economy going forward, especially with sort of the noise around his position?
I mean, it's a difficult time to provide forward guidance of any sort. As you've just discussed, the tariffs are changing pretty rapidly, both up and down, and there's a lot of uncertainty in the economy. We haven't had tariffs like this at this level since the Great Depression, so it's not in the statistical databases that most economists use to do their modeling. So it's very difficult to provide a clear guide. But I think what the chair has done quite effectively is talked about what the mandate of the Fed is, which is to focus on getting inflation to 2% and having maximum employment consistent with that goal. And I think he's very clear in each of his press conferences that that's what they're trying to do, and not trying to overreact to announcements that can change over a weekend.
Shelly, I want to bring you into this. Talk to us about why it's so important to have this independent central bank, and sort of what are the threats when you have the executive branch looming over it?
Well, I have to completely agree with everything Eric has said. I'm a former Fed staffer myself, and it is clearly very, very important to have a central bank be independent from the political process. The central bank has a dual mandate. The Fed has a dual mandate for inflation and full employment, and there can be tensions between those dual mandates, and particularly now in this situation where if we are in a situation where it's a high tariff scenario for several years, we could have significant negative impacts on economic growth, on employment, and also increases in inflation. And it's going to depend what happens with inflation. Is it a one-time pop-up? It's temporary, it comes back down. Okay, then the Fed can focus on the employment mandate. If inflation expectations become unanchored at the long end then you've got inflation spilling over. It's much tougher to bring it down. As we've seen, we're still not at the 2% target. So then it is very difficult for the Fed, and they have to be independent from the political process to make those tough decisions for what is going to be best for the US economy in the long run.
So Shelly, the Fed has used sort of what's now become a dirty word, transitory, again, when talking about these tariff potentially induced inflation. But if we look at the data, right, to your point, inflation wasn't necessarily trending down toward 2 anyway. So were they already tilted sort of on that inflation side and was going to lean in that way anyway? And so maybe these rate cut forecasts, which are still actually out there, probably still need to be taken down?
I think, again, I'm going to agree with Eric here. I mean, there is so much uncertainty on this. And yes, we've seen on the consumer survey side that year ahead inflation expectations have popped up to, I think it's 6%, and 5-year ahead have also gone up to around 4.4%. Now, that's what we call soft data. And that might not necessarily translate into hard data. And the hard data is looking at where you are on nominal yields compared to sort of inflation index yields. And right now we aren't seeing too much movement on that. Now, that could change depending upon how long we stay in this high tariff situation.
Eric, do you think that we are heading for a recession as a result of these tariffs?
I think the probability has gone up significantly relative to where we were at the beginning of this year. So, as was just discussed, tariffs can both slow down growth, which causes higher unemployment, and they can also raise prices and potentially start affecting the underlying rate of inflation. So I do think that it is an elevated risk of inflation, of recession. And I would put it probably at 50 or 60% at this point. You go into any store and talk to people in the store, and they're talking about tariffs. Very rarely do you see people so focused on economic data and pricing data. And that's attention of consumers, that's attention of small businesses, it's the attention of political figures. So it's front and center for most people. And to the extent that both businesses and consumers hold off on purchases because they're concerned about what the outlook's going to be and whether policies are going to change significantly, that alone can have a very big impact. So I am worried that we're going to start hearing more about layoffs. We're going to start hearing more about deferred decisions for investments. And so in many respects, the way the tariffs have been rolled out has been quite counterproductive.
So Shelly, I'll kick it back over to you. So you made a point earlier about sort of this disconnect between hard and soft data. Do you sort of have a view of sort of how that could resolve, right? So soft data surveys, but hard data is actually a reality. Or are we just in a point, as both of you have said, that right now there's almost just too much uncertainty to say, well, when could those sort of recouple?
I think we're going to need to see more data in the coming months. I mean, we did have retail sales come out, and the non-auto part of retail sales was a little bit lower than had been expected. But what is that from? Is that because people pulled forward their auto purchases in advance to kind of get ahead of the tariffs? Well, that would naturally have reduced some of their other purchases they might have made. So I think it's just way too soon to say that the soft data right now from the consumer surveys that we're seeing is feeding into the hard data.